Well, despite a fantastic finish to the week, the NASDAQ is still down more than 20% this year. What's ahead for the tech sector, and can it keep the economy from falling into a recession? Our coverage from Davos continues now with the chairman of North Island and co-founder of Silver Lake, Glenn Hutchins, who's also an economic advisor back for President Clinton and sits on the Boston Celtics executive committee. Glenn spoke with our Andy Serwer.
My working assumption is I think we have to expect a recession in 23. Not projecting that's going to happen, but I think we have to plan for that. I think that's because the inflation that we're experiencing now, 6 to 8%, is roughly half structural or persistent. So I feel like we have a real economy about 3 to 4% inflation, a point or two above the Fed's target. That means the Fed's tightening will have to go on longer and be more durable in order to get that under control. Most of the causes of inflation are not within the are not things that the Fed's tools can really address, and so it feels to me like that. And secondly, monetary policy is a blunt tool, not a surgical instrument. So I think we have to plan for recession, and that has enormous consequences for corporate earnings, which we can come back to if you'd like.
So how does one position oneself then, or what are you thinking, or what are you doing?
Well, it depends. So first of all, if you're a company, I think you have to make plans for slowing of consumer spending and your exposure to that. Also for a continuing increase in cost of what you do, whether it's labor or raw materials. And by the way, that's the kind of behavior that the Fed wants to induce. In other words, they want economic activity to slow down in order to bring inflation down. If you're an investor, I think, I talked about this at year end, but I think in anticipation of this, what I've told people is to get out of the frothiest parts of the market, but the market's done that for them. If you're an investor right now, I would expect that if we do end up in recession, that there will be we've been through a PE tightening already, and when earnings adjust, when the E goes down, I expect a second leg. So I'd be very, very concerned about it, less about valuation-sensitive companies now and more about earnings-sensitive companies.
Shifting gears, we're here at Davos, of course, and you're the chairman of CARE, that NGO, and you were in Poland on the Ukraine border. Quickly, what did you see there, and what was that like? Well,
I spent, in addition to observing our work there, I spent a day volunteering at the border.
Right.
And greeted buses from Kharkiv and Mariupol in particular, and welcomed the refugees into Poland. I met a young woman named Svetlana, who, as far as we could tell, all she had left in her life was the backpack on her back and a big dog at her side. And she said to me, "Why won't you stop him?" And
him being Vladimir Putin?
Yeah, of course. And a principal lecture on geopolitical realities didn't seem, merited. I met another man, 85 years old. He said, in 1941, I fled to Russia to get away from the Germans. Today, I'm going to Germany to get away from the Russians. Those were the bookends of his life.
Yeah, it's really shocking. Shifting gears again, a big topic here besides deglobalization is crypto. And
what's that?
Yeah, well, you're a big crypto investor.
Yeah, I am, yes.
And I want to know what your take is on that.
So, look, I think that crypto is a long-term, hugely important innovation. People think about it as either as about coins or about blockchains. I think it's best understood as a new mode of commerce and a new paradigm of computing. Point number one. Point number two, any new technology like that will go through cycles, ups and downs. There will be good companies and bad. The bad companies will go away. The good companies will thrive. Just like the internet crisis of 1999, Pets.com and Web Van went away, and Amazon powered on to greater success. So the point here is not to diminish crypto, but try to understand what the best companies are and invest in those.
You are a minority owner of the Boston Celtics. They're playing Mike Claudio's Miami Heat over here. And just wondering how sanguine you are about their prospects going forward.
It's a great team, plays enormous team defense. They got a coach that has worked wonders with them. Got an emerging young star named Jason Tatum, the best defensive player in the league. Defensive Player of the Year, Marcus Smart. But it's a team, and I'm very optimistic.
That was North Island Chairman Glenn Hutchins speaking with Yahoo Finance's Andy Serwer at the World Economic Forum in Davos, Switzerland.
We continue our coverage of the World Economic Forum, wrapping up this week in Davos. Our Brian Sozzi spoke with KPMG U.S. CEO Paul Knopp about the latest uncertainty surrounding the markets and what it's like leading a company through geopolitical troubles.
The topic of geopolitical cooperation is huge. The economy is bringing us some uncertainty right now, so we are hearing a lot about the impacts of supply chain disruption, inflation. There's no doubt, too, that we're talking a lot about future technology, whether it's technology for green transformation, the fourth industrial revolution, harnessing the power of it with Internet of Things, with 5G, robotics, artificial intelligence. Those have been very important topics over the last 2 days, too.
There's one thing I didn't appreciate coming into this, a lot of focus on a U.S. recession, but as I talk to leaders, I hear concern about what's happening in Europe. Are you hearing the same thing?
Well, certainly the world economy is interconnected, so we certainly pay attention to what's happening in Asia, Europe, and the U.S. as we think about what outcomes might be for the economy. And we're on the watch for a potential recession. It's unclear as to whether or not that's going to happen in the U.S. or not, but it's certainly something that we're closely watching.
Is Europe in a recession?
Well, I'm not an expert on Europe, but certainly it's a very complicated environment right now when it comes to monetary policy, fiscal policy, and we're very attentive to the risks that come out of any potential economic downturn and constantly looking for the signals that might tell us how we might need to adjust in the future.
Are you getting the signals in the U.S. that we might near a recession?
Well, in the U.S., certainly there's a bit of a lack of clarity about the potential for a recession, just given some of the unprecedented things we've lived through, right? $5 trillion of stimulus, for one thing, rising wages, which help mute the impact of that. But we certainly know that cost of food, fuel, have a disproportionate impact on those that can probably afford it the least. So we are watching very closely what signals that sends and whether or not it might result in a more severe downturn. We're very hopeful that if there is a recession, that it's going to be short and shallow.
Are we near peak inflation? Give us some optimism.
Well, I'm not an expert on whether or not we're near peak inflation, but I will tell you that it seems like that the action that the Fed is taking is in response to the inflationary environment, and it seems like they're doing the things that we need to do to try to tamp it down. So we're going to be watching that very closely.
We've talked a good bit in the past about the war for talent. Finding best-in-class talent continues to be very hard. How is it looking over there at KPMG?
Well, we are certainly doing fine in finding talent. It's almost like a bit of a Where's Waldo now when you're looking for talent to serve the needs that you have in your company. So we're attracting a lot of talent. We're really focused on retaining our talent too, though. It's building a best-in-class culture, and we're using culture as a differentiator to ensure that our talent stays with KPMG to build a career.
I think it was Bank of America yesterday. They raised their starting wage for employees to $22 with a goal of taking it to $25 by 2025. But you also have been raising wages very aggressively over the past few months. Where does that stand now?
Yeah, we have raised wages very significantly by double digits, record annual wages, raising them as well as bonuses. So we're meeting the market when it comes to compensation and definitely trying to differentiate, as I mentioned earlier, based on our culture for the future.
Increasing wages by double digits, is that the new norm in this environment?
I think it's the norm for where we are today in a very unusual time in our history, where there's tremendous demand for certain talent and technology, cyber, digital transformation, transaction-related work. So there's definitely pockets of real hot labor market right now, and we're very much focused on those, but it's happening in every sector. So, it is not something that will persist forever, but I think we're going to see it for the next 1 to 2 to 3 years.
If I'm right, you took over as CEO during the pandemic, correct?
Right, July 1st, 2020.
What has it been like from a leadership perspective, running a company like KPMG when up is sometimes down and down it might be up?
Yeah, so first I'm honored and humbled to lead KPMG, and it's just been an amazing experience to lead KPMG through a period with enormous change. And you think about the pandemic and what that has changed, and it's changed everything. You think about the social justice crisis we faced after George Floyd was murdered. You think about the economic uncertainty that the pandemic brought, and now that supply chain disruption and inflation is bringing, and then just the complexity of the geopolitical environment. It's given us all as leaders a lot to think about, a lot to ensure that we're digesting and making sure that we're focusing on what the change might do to our business models for the future and how we change to make sure that we stay relevant for decades to come.
Last one. Have you closed any big deals yet?
We have not made any major acquisitions recently, but of course we're always looking.
Our Brian Sozzi got a chance to speak with Cisco CEO Chuck Robbins on the state of tech and the ongoing effects of supply chain constraints. They talked, of course, in Davos, Switzerland at the World Economic Forum.
Well, I mean, clearly there's a lot of issues in the world right now, and everybody wants to get declarations from every attendee here about whether there's going to be a recession or when does inflation end, or all of these kinds of things. And I think that, look, I don't want to see us talk ourselves into a recession, first of all. And I also think people are a little too pessimistic. I mean, if you think back over the last several years, the challenges that we've all dealt with as a global society, we should have confidence that we're going to deal with whatever comes our way. And I thought that Carmine was right. Whatever happens likely is short-lived. But if we look back on the success we've had over the last few years in a very complicated world, it should give people hope as we look to the future.
Yeah, every conversation that I had has had this layer of gloom. This is not the same type of Davos I'm used to. Usually there's a lot of optimism here. But what ultimately, I mean, do you think we're talking ourselves into recession? Are we at that point?
Well, first of all, you can take solace in the fact that in March of 2020, when we were here, we were all super optimistic, and then we went into a 2-year pandemic. Mm-hmm. So we're never right. Okay. So I think the consumer clearly will make their own decisions about spending. But I think at a business level, if we all walk around here talking to each other and we're all talking recession, as CEOs, we actually define capital spending and OPEX spending in our organization. Mm-hmm. So if we go back and say, we think there's going to be a recession, so slow down spending, then that will ultimately could lead to it. So I just think we got to be cautious about it and just take it, a day at a time and see how things go.
I had a bunch of other questions planned for you, but I got a chance to sit in on your panel today at the World Economic Forum. It was very interesting. And my question now is, are you getting enough help from governments to get done what you need to get done and drive digital transformation?
That's a really good question. I think the intent is there. I think, government is bureaucracy, unfortunately, and so it just takes longer. I mean, I think I've had lots of discussions in Washington about the need for public-private partnerships. We really need to be coming together quickly to solve some of these supply chain issues, and it's going to take both to really, if you want to get it done quickly. Talking about investing in technologies that are 6, 7, 8 years out. We should be thinking about how we do that to for the U.S. to remain competitive for sure, but even on a global basis. And I think the technology is moving so quickly right now. I think that it's incumbent upon companies to very honestly engage with government to help them understand how they should be thinking about the regulatory requirements, because we live it every day and it's complicated. And I feel really bad for these regulators who are trying to regulate technology that's so complicated, that's moving so fast. So I think we just need more and more interaction. I spend so much of my time with government today.
Do you think they realize, though, that you have to charge a fair price for what you do?
Yeah, I've never had any pushback on our pricing model, but that generally is focused on protecting the consumer more so than it is. We're B2B, so it doesn't come into play as much here.
Good to hear. Supply chain challenges. You're coming off your most recent quarter here. Is there an end in sight? When will more products be on the shelves?
I think there is a beginning of a recovery in sight, I think. So here's what I would tell you is we got to get through the China lockdown.
Mm-hmm. Is that Shanghai?
Last I saw last week, there were like 40-plus cities in lockdown over there, a quarter of the population. So but Shanghai is the most obvious. And we have components that go into other components that go into our products that are coming out of Shanghai. So that's been one of our big challenges, which led to the earnings results. I think most technology companies over the last 9 to 12 months have been taking on redesign issues. So we've been redesigning products where we have serious component issues, replacing them with other components where we can get those. that stuff for us is going to start showing up in August, September. And I also think some of the non-semiconductor problems in the marketplace, I think the second half of the year, we should start to see that ease a little. And then hopefully semiconductor capacity starts to increase as we get into 2023. And if we do see a little demand weakening, then that certainly helps get supply-demand back in check a little sooner.
Any easing in inflation?
Not that we've seen as of now.
What parts of your business do you see it hitting you the most?
Just on the component side. I mean, all of our input costs for our products, the semiconductor components industry is a very tight-knit group, and the demand is so overwhelming that they have just complete pricing power. And so, they're doing what they do, and they're taking advantage of the demand to actually increase their revenues, and it's getting passed through.
Last one for you. There's very few executives I have talked to here that have your experience, that have seen a lot of different tech cycles. Explain for the average investor out there what is happening in the markets with tech stocks.
I think you just called me old. Thank you, Brian.
You said that. I didn't say that.
Walking around Davos, I told my team, I said, I am officially a senior citizen here. I've been here so many times. Look, I think valuations were, you could argue that they were extreme. I mean, in many cases, relative to how the market has historically been priced. And so we were talking earlier about a lot of the smaller technology companies, whether public or private, a lot of them are run by young entrepreneurs who have never seen a downturn. So they're struggling now with, was that high price my valuation, or is this low price my valuation? And they don't really know. And if you look in the private markets right now, late stage private companies are, in general, are cutting back their valuations from the last raise, which is, it's hard for them to deal with. But I just think it's a correction, and look, it's going to ultimately create a buying opportunity for lots of people, and I think you just got to decide when that's right for you.
We want to talk a little bit more about the markets, what we're seeing play out in fixed income specifically, and for that we have Kathy Jones, Charles Schwab, Chief Fixed Income Strategist. Kathy, help us make sense of what we've seen recently in the bond markets. Like Jared just said, we're seeing some relief in the 10-year yield today, pulling back just a bit, but still hovering around 2.7. Help us make sense of these recent moves.
Well, I think the bond market is responding to a couple of indications. One is that we're seeing some hints of somewhat moderating growth. There's some recession worries out there. It may be a little too early to call a recession, but we have seen some of the economic indicators come down a bit. And we've also seen, the Fed talk about tightening and talk about tightening and talk about tightening. And the more they do that and the more they signal that they are dedicated to getting inflation under control, the easier it is for the bond market to kind of relax a little bit and say, okay, we're going to see hikes in short-term interest rates, but we're seeing inflation expectations come down, and that's actually helping lift the bond market.
Kathy, anything surprise you from the Fed minutes today? And given how everything has, the world has changed since that meeting. We had Snap, we had Target, we had Walmart, we had new and existing home sales have plummeted. How relevant are the Fed minutes?
Well, they're a little bit old at this stage of the game, and we already had, of course, a press conference after the meeting, so we knew most of what was coming out. I do think, although there were no big surprises in here, there was a commitment on paper to say we're going to go at 50 basis points at a time until we feel more comfortable, we're closer to neutral. So that's at least two more 50 basis point moves, and as we get into the fall, maybe a couple of 25 basis point moves. So it was fairly explicit guidance there, which is a bit more than the Fed often does. Now, best laid plans, they may not get there. There was some reference to those tightening financial conditions. As you indicate, stock prices are down, credit spreads are widening. All of these are indications that typically the Fed might be concerned about, but right now they want tighter financial conditions, so they noted them, but really didn't make any indication it's a concern for them. And then I think the third thing that might have been somewhat interesting is there is some talk among the members to actually have outright sales of their mortgage-backed securities. But that's well down the road after they've finished this roll-off process. So it was noted in the minutes, which is unusual, but there is no time frame on it, and it seems to be a very long-term event when and if it happens.
Kathy, given how the circumstances, as I just mentioned, have changed since that meeting, how does it alter the job, if at all, of the Fed?
Well, I think for right now, they want to stick with the plan that they have, but they're going to have to watch the economic indicators pretty carefully because, inflation's still elevated, although we're seeing, a little bit of a sign that it might be starting to come down a bit. But they're going to have to watch those financial conditions. They're going to have to make sure that some of the decline in the markets doesn't spill over into the real economy. In other words, if companies can't fund themselves in the capital markets, if we start to see lending really get curtailed, unemployment start to rise, then I think the Fed has to pay attention to that, and that might alter their plans. But for right now, they'd like to stick with whatever plan they have, at least for the next 4 to 6 months.
And Kathy, given the uncertainty over the Fed and exactly what the Fed policy is going to look like 6 to 12 months out from now, what are you telling your clients?
So we came into the year suggesting that clients keep the average duration in their portfolios low, meaning not take a lot of interest rate risk. But now that rates have moved up so much and the Fed's actually being aggressive, we think it's time to start actually adding some duration into intermediate term bonds, say, because the yields are much more attractive than they've been before. And whenever the Fed's in a tightening cycle, you usually see at the peak sort of a convergence, a flat yield curve. And we're starting to see signs of that. So we're encouraging, on the one hand, a little bit more in the way of exposure to interest rate risk, but less exposure to credit risk. So as the economy shows signs of slowing down in response to Fed rate hikes, we really want to be concerned about, not being too low in terms of credit quality and say those high yield bonds or emerging market bonds of very low credit quality, because that's usually where it starts to hurt when you start to see this tightening in global financial conditions.
June 14th, the next meeting. Do you sense that Jerome Powell will do whatever it takes, no matter what we see from the markets, to tame inflation?
That's certainly what he's saying consistently over and over again. And I will only note that he has invoked the name of Paul Volcker many times over the last couple of months. No one wants to be the Arthur Burns of the modern day Federal Reserve, the guy who let inflation get out of control. They all want to be now Paul Volcker, the hero who got inflation down. Now, you might have different interpretations of whether all that's true, but he has used Paul Volcker's name many, many times. So I think there is a commitment there to getting inflation down.
Kathy Jones, Charles Schwab, Chief Fixed Income Strategist. Thanks so much.
U.S. CEO confidence is taking a hit as some of the nation's top executives increasingly point to a recession. The latest Conference Board survey shows 60% of CEOs see economic conditions worsening this quarter. So what's behind all of those worries? Brian, of course, standing by here with a mini Yahoo U. A full Yahoo U.
Full Yahoo U. I mean, we're in the classroom. Well, there's only one student here, and it's Akiko, but class is in session.
I'm here.
Present. Class is in session, and it's no secret the markets have been flashing red with concern basically all year. And as Akiko mentioned, CEOs are getting less optimistic about the economic picture. So this is a chart that comes from the Conference Board. It asks corporate bigwigs about how they feel about general economic conditions. And as you can see, the print shows a huge drop in consumer sentiment in the second quarter. This is the worst since 2020. And we really know the culprits for all of this, right? So high inflation, for example, is eroding purchasing power. That means the Fed is going to have to raise borrowing costs. That's disrupting markets. And then there's also the problems overseas, right? The war in Eastern Europe and COVID-related shutdowns in the world's second largest economy. All that makes for a nasty combination of global factors that spill over here in the United States too. But of course, these are just things on paper. The question is, how do they translate into an economic downturn? And for that, we have to think about corporate earnings, right? So shipping costs rise, materials get more expensive, that cuts into margins, lower corporate earnings. It also means that companies invest less because higher borrowing costs make returns on projects a little less attractive. That makes business investment go down. And then consumers, we all know this, buy fewer things as the basket of stuff they have to buy, like milk or eggs, gets very pricey. So these are the actual mechanisms by which the economy can slow down. And all of that is the underpinning, Akiko, of the recession concerns that are rippling through the stock market and C-suite offices and just in dinner table discussions across the country.
So how does it look right now? I mean, what are the economic indicators pointing to? We have heard the technical definition of a recession. But what exactly are we seeing?
Well, you ask about the definition of a recession. I've got the textbook definition right here, at least as most people understand it. They say it's 2 consecutive quarters of negative growth in U.S. production that's measured in real GDP. And when you take a look at the chart, we already got 1 negative quarter of GDP in the first quarter. But what you need to really look at is the pace of economic growth in the United States. And again, this is a chart of rates in U.S. GDP over the last 10 years. And what's interesting about this trend that I really want people to notice is that over the pre-pandemic period, really trend of growth in the United States was not all that high. But if you notice, again, it's not a very noticeable jump here, but the trend over the pandemic period, at least of U.S. economic growth, has been relatively higher than the trend that we saw pre-pandemic. One interpretation of that is, well, the U.S. economy has been running hotter than it normally does, and that's the reason for why we see the inflationary environment. So we're probably going to need multiple quarters of further negative growth to depress the demand. Again, think business investment, think consumer spending that led to the post-pandemic boost that we got here in the first place. Now, the bigger concern in this hypothetical recession is therefore not necessarily GDP growth, but it's losing the jobs that we fought so hard to get back since the pandemic. So the largest labor shock that we've seen in modern history destroyed over 20 million jobs, as we all experienced and know about from 2020. And then if we see, we actually recovered almost all of them back to this point. It's still a little bit of a shortfall, but it's pretty remarkable that we've been able to recover that much. So think about if we do go into a recession. Ignore the GDP side of things. If businesses go bust, hiring sharply reverses, do we start to lose that? That would be a big deal. And that's why these recession fears are indeed warranted. So in the end, we're going to have to sacrifice some economic growth to get ahead of this. But the broader question, Akiko, can we save jobs while doing it? And that is where the recession risk is.
And we've already started to hear from some of those high growth companies, right, in the tech space who've said, look, we're going to cut back on some of those jobs. Obviously, you know, the question is that just an indication of how quickly those high growth companies grew, or is that an indication of something larger that we're likely to see?
Yeah, and when we talk about the tech companies, we have to remember that these were high-flying companies that had a lot of money. They were flush with more cash, had a lot more money to invest in research and development during the midst of the recovery. And that's the reason why when I talk about business investment, people are very sympathetic, understand the consumer spending side of things, but research and development, all the money that went into there, we saw a massive surge through the stimulus. As that reverses, how many people are going to be laid off because they were part of those projects? White-collar workers who are perhaps part of that are now being trimmed because the companies are deciding that those projects are no longer something they want to invest in. Now, of course, that is a different story than, say, the blue-collar jobs that have been a big part of the job losses since the pandemic. Again, leisure and hospitality, restaurant jobs, those were all the front-facing, high-risk contact jobs that were really affected. But if the large corporate companies that are also fueling a lot of those hiring, think of the big publicly traded fast food companies, that could be a big part of this story as well.
Yeah, a lot of people just kind of taking a deep breath and strapping in for the next few months as we follow the news. Thanks so much for that, Brian.
Our stat of the day here, across 12 recessions since World War II, the S&P 500 has fallen from peak to trough by a median of 24%, points out Goldman Sachs. A decline in this magnitude from the S&P 500 peak of nearly 4,800 in January would bring the index to about 3,650, or 11% below current levels. The average decline of 30% would reduce the S&P 500 to 3,360, or 18% from lower from today.
We're going to talk about consensus on Wall Street. That seems to be that we're at recession crossroads, quote unquote. Though where we go from here, that appears to be anyone's guess. JP Morgan's Marko Kolanovic says that things might be getting better as the year progresses here, and it is very much a highlighter and pen type of day here on the desk, particularly here. The JP Morgan view is that equity markets price in too much recession risk. However, they're also saying that equity markets, they estimate U.S. and the euro area equity markets are pricing in a 70% probability of a near-term recession. That's compared to 50% in high-grade credit, 30% in high yield, and then 10 to 20% in rate markets as well. They also call into question the April equity fund outflow, and particularly here when we saw heavy selling activity, even early in the month of May, as we continue to move through only the midway mark right now. We're still consistently seeing that heavy selling pressure. That's exactly where some of the markets are already starting to pre-price in the risk of a recession ahead of the economic data actually revealing that as well.
Yeah, I have a little doom and gloom of myself there, Brad. I'm looking at a note from David Kostin over at Goldman Sachs, and he's noting that, quote, rotations within the U.S. equity market indicate that investors are pricing elevated odds of a downturn compared with the strength of recent economic data. So it is interesting to hear that type of commentary from a well-known name on Wall Street like Kostin, but really fires me up and gets me a little concerned here is that Kostin is really one of the first strategists to call out potential dividend cuts by companies. He's noting that dividend futures markets imply S&P 500 dividends will decline by nearly 5% in 2023. He notes that during the last 60 years, S&P 500 dividends have not declined outside of a recession. So something to keep in mind moving forward. And something I did see in a couple notes off of Cisco's earnings as well overnight, some concern about whether a Cisco will be forced to cut its dividend inside of a recession.
Yeah, so a lot of diverging opinions this morning. I'm looking at Deutsche Bank's Binky Chadha, his note where he cut his forecast for the S&P 500 to 4750. I mean, he's still obviously bullish from here. 5250 was his prior forecast. But I think more importantly here, he is looking at the scope for further sell-off before we get to a rally. He says right now, if you look at an average decline in the S&P 500 during a recession, it's 24%. So we're about 3/4 of the way there. But he's looking at the prospects for further sell-off based on, basically, we're seeing slowing growth. We are late cycle here. Secondly, he's looking at the drawdown in valuations for high-flying tech stocks. And third, he's talking about inflation and that the Fed is going to continue to raise guidance. Now, he says if we do go into a recession, that we are going to see a much more deep sell-off than is typical. So we could see something even 35 to 40% for the S&P 500. But he is a little bit more optimistic than that and thinks that we are going to have this drawdown and then there's going to be a bounce in the latter half of the year.
We'll talk about those two developments with Bob Nardelli, which will be interesting, Jared, to hear about Walmart. For more on the markets, let's bring in Ryan Dietrich, the LPL Financial Chief Market Strategist. Good to see you, sir. So let's talk about some of the optimism that comes from what Jerome Powell said, that it is very challenging, but it is a healthy economy. He still believes we'll have a soft-ish landing, and not entirely clear what he means by soft-ish. Sounds like you're optimistic.
Yeah, Jerome Powell, I think, is covering his bases there. I don't think he said anything that caught us off guard, but like Jared just talked about, buyers are stepping in this afternoon. I mean, let's not forget, though, where we are, right? S&P down 6 weeks in a row, hadn't been down 7 weeks in a row for like 20 years. So we know we're awfully oversold here. Then you come in today and you've got industrial production pretty solid. You got retail sales pretty solid. You know, things aren't perfect, but we just think so much of this negativity that is priced in after this, near bear market. I mean, we could go or flirt with bear market on the S&P, median stock down like 25%. So you're almost in a bear market. It's just a little overboard for us. And we think, this very well could be an opportunity for longer-term investors here.
And we have had guests say, look, this is the time to perhaps get your shopping list together. If you were to get your shopping list together, based on historically how you've seen the market react after these corrections, what would be on it?
Yeah, well, there's what's the old saying, right? The stock market's the only place things go on sale and everyone runs out of the store screaming. So, things are on sale here. We almost take like a two-pronged approach here. Who brought you to the dance? I mean, you just mentioned, some of the materials are doing well, some energy's doing well. I mean, those two groups you like, but the other side of things, that's kind of your cyclical value. The other side of things, I mean, tech, right? We're more neutral tech. But I'll tell you, the second half of this year, if yields start to go lower, the economy can pick up. We finally have some good news. I mean, these tech names have just been obliterated. We all understand that. But the second half of this year, we think tech could be a group that could do well, and don't forget how strong and influential that group is. So those are have a two-pronged approach that we think makes a lot of sense here.
Ryan, let's take a look at the retail sales number because it was strong once again in April, the fourth month in a row that we've seen an increase in retail spending. Do you think we're making too much of the fact that obviously inflation is a huge deal, but maybe the consumer is simply more resilient than we had anticipated?
Great point. I mean, we've said for a while the U.S. consumer is one of the linchpin, right, of the largest economy in the world, makes up about 70% of GDP. So this is just one example. I mean, let's not forget on Friday, we're talking about the Michigan consumer confidence number coming in, I think, the lowest in about 10 years. So, consumers are saying one thing, but they're kind of doing another. And that's why it's so important to pay attention to what they're doing. I mean, things aren't perfect. Let's make that very clear. But with the consumer, they're still in awfully good shape. I mean, balance sheets are healthy, spending is strong. We all know the employment backdrop is relatively strong as well. If you want to get a higher paying job, this is one of the best times in a couple generations to go do that. So, the consumer still looks good to us. And that's one of the main reasons, honestly, we don't see a recession in 2022. I know some people do, but we look at the consumer as strong, with some of the other things we've been seeing. And it just makes sense that, this is a mid-cycle slowdown, a la 94 kind of. We just don't see us heading into a recession here.
It sure is nice to hear some optimism, man. We will take it. You tweeted about a BOA fund manager survey, which shows the most cash on the sidelines since 9/11, indicating what?
That's right. I mean, it's cliche to say, right? Cash on the sideline. How many times you guys had someone on a show the last few years talk about it? But it's true. When you look at the Bank of America Global Fund Manager Survey, kind of a mouthful there is a lot of cash, right? And it makes sense. I mean, stocks have done poorly. We all know the scary headlines, but there really is a lot of money that could come back into this market soon. I mean, retail investors, they've been banged up, right? They've got a lot of cash also. So this is just one contrarian indicator. Put to call ratios are high. Various sentiment polls are flashing levels we've seen at major market lows going back the last couple of decades. So, all these things together suggest expectations are so low. From a contrarian point of view, if we can get any good news, and maybe that good news could be, hey, instead of 10 hikes this year, it's like 7 or 8. That's not necessarily a dovish pivot in our opinion, but maybe that could be some good news with an economy that can keep growing, that all that money can come back, not all that money, but a lot of that money could come back and likely push stocks a good deal higher in the second half of this year.
And we did see a lot of retail investors panicking when they did see especially a lot of these tech stocks start to go down. If you're a retail investor and you're wondering what to make of this, do you buy the dip and what sort of strategy do you use? What advice would you give them?
Yeah, I guess it always depends on the time frame, but for your average investor, I mean, when you look back at history, guys, if you don't have a recession, right, you rarely have stocks down more than 20%. We had like 1978, you had 98, you had 2011 and 2018. S&P pulled back 19%. All those times you did not have a recession. If you have a recession, all bets are off. Things can get worse. The only time in the last 50 years we've had a pure bear market down more than 20% was in 87. Okay. So again, if you're not in a recession, we just pulled back 18% on the S&P. For your average investor listening, things are scary. But if you're not in a recession, like we don't see happening, this could be a time to remember to dollar cost average in, continue to invest for the long run, because again, stocks will likely be a good deal higher 6 to 12 months from now. That's what people need to remember.
So Ryan, given that outlook, do you think it's fair to say, do you think we have seen the bottom, at least for now?
Yeah, for now we do. I mean, we wouldn't be shocked at all if there's some type of a little summer rally. I mean, what we saw last Thursday, the last hour, and then Friday's continuation, and cross our fingers, today's continuation. This very well could be a multi-week, maybe a multi-month bounce. Do not forget this, though. Midterm years are very volatile. I think we can check that off. They tend to form the ultimate bottom late August, September. So maybe we can go back down and retest this. But for the near term, we think a well-deserved bounce from historically oversold levels makes a lot of sense. But we don't think we're going to just crash right through there. Maybe we retest them. And that, again, from an investor's point of view, is looking for several years out. This is a good time to continue to add, even on more weakness, continue to add here.
Certainly some refreshing optimism there. We do appreciate you joining us today. Ryan Dietrich there, LPL Financial's Chief Market Strategist. Thank you so much.
Welcome to Yahoo Finance Live, and happy Monday to all of you. I'm Akiko Fujita.
And I'm Brian Chung. It is Monday indeed. Unfortunate news on that front, but the good news is you get to hang with us for the next hour, 11 a.m. on the East Coast here. Let's take a look at markets so far as we are an hour and a half into the trading session. Dow Jones down 0.5%, the S&P 500 up 0.8%, and the NASDAQ down 1.4%. So red across the board, although, of course, after those 3 to 4% down days last week, we'll take, I guess, whatever we can get. On the bond yield front, we've actually seen some interesting movement in the U.S. 10-year, with the yield actually going down to about 2.88%. That's down about 6 basis points. Keep in mind that the 10-year yield was above 300 basis points only a few weeks ago, so some interesting movement on that front. But of course, Akiko, we're watching a number of different types of economic prints coming from abroad, also paying attention to the world's second largest economy in China, where you saw economic data across the board really looking quite ugly.
Well, and we're seeing that weigh on investor sentiment in the session right now. We saw industrial output as well as consumer spending fall to the lowest level since the pandemic began. Retail sales were down 11%, industrial production down nearly 3%. And Brian, a lot of this is, of course, because of those COVID lockdowns that we have seen over in China. By the way, unemployment rate fell to 6.1%. That also raising alarm for those who are watching very closely how significant the second largest economy is.
Yeah, certainly. And, you know, when you talk about kind of all of these factors and readings on industrial production and on unemployment and on economic activity, it's no surprise because of the shutdowns that we saw. So the next natural question is the worst already past China? And what we know is that, at least in the city of Shanghai, where we've seen a lot of those factory closures, it's disrupted effectively a lot of global supply chains. The city said yesterday they would start to allow restaurants to reopen. They said gradually, hopefully by the middle of June, maybe something in Shanghai would look a little bit closer to normal life. Now, of course, you can't appreciate just the social impact of the lockdowns that have been happening in China, which here in the United States, you kind of don't realize. It's been many months that people have been stuck inside their apartments, unable to go outside. Social media in China, very good at kind of censoring any sort of, protest that people have been doing digitally to kind of call out the government for how stringent these measures have been. But at the same time, is that going to corrode kind of the attitudes and the expectations for an economy that's essentially been pushing 6 to 10% GDP growth for effectively the last decade? What is that going to do over the medium term?
Well, and you have to wonder how Xi Jinping manages the messaging. If you look back to what was announced several weeks ago, he came out and said that there would be significant infrastructure investments to be able to stimulate the economy. Now, a lot of people saw that and said, that sounds very similar to what happened in 2008, post-financial crisis. Obviously not on that level, but that's another sign that China is seeing that slowdown. And this is an interesting chart that we got from the Atlantic Council, Josh Lipsky's team over there, shout out. You see right here why we're watching the Chinese economy so closely. And you see the past cycles, recessions that we have seen in the past. China outspent the U.S. and outgrew the U.S. significantly. And if you look over at where 2023 are, and this is, of course, still estimates, it shows just how much that growth has slowed down. So any kind of slowdown we see in China, certainly going to have an effect globally, not just here in the U.S. By the way, Bloomberg estimating that China's GDP contracted for the first time since February of 2020 in April. You're talking about 0.7%.
Yeah, and we have to remember that these types of things that are happening in China are absolutely going to have, / already are having, ripple effects on the U.S. economy as well. I mean, you saw that Goldman note over the weekend where the economists there downgraded expectations for U.S. growth in the second quarter this year to 2.5% on an annualized basis, quarterly annualized basis. But they were saying a lot of that is because of the drag that comes from a larger inflationary impact of supply chain disruptions in China. And we're already seeing kind of signs of recession worries here in the United States, where obviously the yield curve inversion not long ago, earlier in the spring. But you also take a look at just measures that we got this morning from the New York Fed manufacturing survey showing a lot of economic activity, at least in the Northeast region, showing contraction. It came in at minus 11.6. It was a positive 24.6 in April. So again, for people that don't normally read this type of index, you might not be knowing what this is worth. But just if you think about this within the context of it's a measure of what manufacturing activity looks like, this is already having an impact. And I think that that's something that's very interesting as part of this overall globalization China growth story in the next few quarters.
Yeah, it's just another reminder of how interconnected everything is.
If you're looking for negative sentiment, Julie, you've come to the right guy, because I have that for you. Now, here are 3 things you need to know right now.
Be ready for a recession. That's the stark warning from Goldman Sachs Senior Chairman and former CEO Lloyd Blankfein, who said Sunday there is a, quote, very, very high risk for a U.S. recession. This comes as Goldman's chief economist Jan Hatzius slashed his U.S. growth forecast for this year in 2023 following recent turmoil in the markets. Meanwhile, Goldman's chief U.S. equity strategist David Kostin took his year-end S&P 500 target down to 4,300 from 4,700. Talk about bad things come in threes here, guys, from Goldman Sachs. But I really would point to Blankfein's comments first and foremost here. This is the first big bank CEO to come out and warn about a recession. I would argue Jay Farner last week, Rocket Company CEO, told us he is banking on a recession. But when you get Lloyd Blankfein here, which is, he's still connected to the markets and plugged into what's happening, when he calls a recession, that's a big worry.
Well, he's sort of calling a recession, but he's also just saying, be prepared for the worst, which is also sort of, good chief executive advice, I suppose, right? Be prepared for the worst. He said we could avoid a recession, but if you're running a company, you want to be in a good position if we are going into a rocky period.
And really bringing into the conversation the supply chain headwind that still lingers right now, noting that while some inflation will go away, supply chains, bringing that back in, and then additionally, you've still got the COVID lockdowns in China that's certainly impacting the broader kind of globalization restart effort, even to make sure that there is some of that supply chain that gets ultimately resolved. But I think at the end of the day, one of the other things that he mentioned, some of these things a little bit stickier, energy prices, that particularly continuing to be one of those shocks, price shocks for consumers as well as businesses that really have to monitor their energy spending as well.
You should have mentioned deli meat prices. My brother just told me this morning he paid $12.99 a pound for salami. I mean, it's ridiculous out there. It
was eggs last week. It's
eggs this week. I told you I'd be coming with something new. Hold
okay.
on. Let me add this, Julie, too.
Please.
Let me go to Kostin's note, because I think that is alarming. Now, the headline here is that he slashed his...
David Kostin, who's a strategist at Goldman Sachs.
At Goldman. Now, he cut his S&P target of 4,300, but buried in his note, he said if we're going into a recession, you could see S&P 500 3,600. So that's a further drop from here.
Yeah, and that's after Jan Hatzius, who's the chief economist at Goldman Sachs, cut his GDP forecast. 2.4% this year is now what he's expecting, and 2023 is going to 1.6%. Oh, and by the way, our buddy Mike Wilson over at Morgan Stanley.
On the show.
Do you think he came out with a super bullish note?
Nope.
No. Mike Wilson is yet more bearish now. While you've got Kostin saying, what's the number that Kostin put it at?
3,600 if there is a recession.
Well, Morgan Stanley's Mike Wilson coming out and talking about we could see a slump to as low as 3,400. He says valuation and technical support would be at that level. And then he said we'll get to 3,900 by next spring. And by the way, I don't think that he is baking in a recession to that scenario. I think he's saying this is going to happen even if we don't enter a recession.
Welcome back to Yahoo Finance Live, everyone. Fear on Wall Street. Wild swings in the markets are raising investor concerns that the Federal Reserve's plan to tackle inflation could spark a recession. But some strategists say, keep calm. We're not there just yet. That's where we find Sozzi's take today. Sozzi, 3 reasons why we are not in a recession. Go.
Yeah, we talked to Michael Feroli at JP Morgan yesterday, and I asked him, do you think we're in a recession now? He pushed back on that. My sense from that conversation was he's not looking for a recession if it happens till later on next year. That's what a lot of economists are looking for. So I went recession hunting to see if we're seeing anything now inside of big companies that would suggest a slowdown. First up on this list, Rivian. We were just tearing apart the company's results, and there I am in a Rivian truck that may or may not be produced, but still, nonetheless, they noted at the bottom of their earnings release they saw 10,000 pre-orders for their R1 vehicle after they lifted prices in March. Now, the average price for these are $93,000 vehicles. So if we were in a recession or slipping into one, I don't think $93,000 Rivian electric trucks would be going out the door. So there's that one.
How much do you have to put down for the pre-order?
Unclear. They didn't list that.
Not $93,000.
Not $93,000. But still, the expectation is at some point you're going to have to pay $93,000.
Right. Yes.
All right, next up, Disney. We were talking about their earnings too as well. If you go into that earnings call and spend some time listening to what Disney team said, they did note that per capita guest spending And its domestic parks up 40% versus the same quarter in 2019, noting strength in food, noting strength in merchandise, and of course, ticket sales. All this stuff likely to coming at higher prices as Disney tries to recover from the depths of the pandemic. And last but not least, we talked to Carnival Cruise Line CEO Arnold Donald yesterday. I think that is me in a cruise. Oh, that's Splash Mountain.
Yeah, that's Splash Mountain.
That's Splash Mountain. Yeah, well, you know, I haven't been to Disney since I was 13. But nonetheless, I talked to Carnival Cruise Line CEO Arnold Donald, asked him if he is seeing consumers spending less on his ships because of economic fears. Here's what he said.
So across the board, whether it's mass contemporary brands, ultra luxury brands, whether it's in spa, whether it's in excursions, whether it's in casino, whether it's in specialty dining, we see across the board increase in spend in retail as well. And I think a lot of that is just people are glad to be out again and glad to be socializing and glad to be building the joyful memories that cruising is all about.
I'm all for building joyful memories. In fact, I'm building them all here with you both now. But I'm just, so all in all, little anecdotes here and there. Of course, my take is this: life is great until it's not. And I mean by that, we could be slipping into a recession. Who knows? You will not know until well after the fact, as is often the case when recessions are dated. But at least right now, small signs indicate that we are not in one. I'll even go with Dutch Bros. Their sales were still up on the most recent quarter. In a recessionary time, you're not going out there buying $7, $8 coffees.
Right. I think you'd be hard-pressed to find an economist who says we have already entered a recession, even despite the contraction that we saw in the first quarter and the first read on the first quarter GDP. My wish for 2022 is to have a real photo of you in the Splash Mountain car. You know how they take the photo of you as you go down?
That does exist, but from when I was 13.
Oh. No, we need a present. We need a current. We need a contemporary
there it is. It's around the screen.
Photo of you on Splash Mountain.
All right, I'll airbrush it.
Please, no digital wizardry.
Right.
We need a real photo.
Oh, okay. We can get to even zoom in. This crew does it all.
But that needs to be real.
They do it all. Love this.
All right.
Well, the focus here for investors has been on the Fed, has been on inflation. And our very own Brian Chung is here with another exclusive interview. Brian.
Thanks so much, Sean. I am joined here live on Yahoo Finance in an exclusive conversation with St. Louis Fed President James Bullard. Obviously, the Federal Reserve very much in focus, so it's great to have you on the program this afternoon, President Bullard. How are you?
Very good. Thanks for having me.
So I want to kick things off with a conversation about the inflationary numbers that we got this morning from the Consumer Price Index, 8.3% on a year-over-year basis in April. What were your broad takeaways from that report?
Yeah, I don't think we want to emphasize one report too much, but my takeaway is that inflation is broader and more persistent than many have thought, and that the Fed will have to act in order to keep inflation under control. And we've got a plan in place, which is, 50 basis points at the last meeting and teeing that up for future meetings as well. I do think we need to get to a higher level of the policy rate to control, especially the persistent part of the inflation process.
President Bullard, I had the luxury of speaking with your colleagues in Atlanta and also Cleveland yesterday, both of them saying before we got this inflationary print, to be fair, they were advocating for 50 basis points in at least the next two meetings. What do you see as the appropriate path of policy in the future?
Yeah, I think that's a good benchmark for now. And, I think we're in, it's a good plan right now. I do think we need to get above neutral by the end of the year. I've been advocating just as a kind of number to put out there, or a goal of 3.5% on the policy rate by the end of the year. I think we're going to have to do more than just get to neutral. We're going to have to go above neutral in order to put downward pressure on the persistent component of this inflation. So, I think the biggest thing here is that you should probably take the big inflation number that we got today, 8+%. Some of that has a transitory component to it. I know we banned the word transitory, but part of that is going to go away naturally, and that's fine and all good for us. But there's a big chunk of it that's not in that category is much more persistent. It's that kind of inflation that requires Fed action. And in order to get us to be able to put downward pressure on inflation, we're going to have to get the policy rate up in a range where we can put some leverage on this and move inflation down. So, we're all in the middle of this process right now, but that's my takeaway for the current position.
Could a 75 basis point move be warranted in your view? I know your remarks on the possibility of that prior to the May FOMC got markets very interested. Do you see that as a baseline need, at least in the next few meetings?
That's not my base case. So I think we've got a good plan in place, and the committee has, based on public comments anyway from my colleagues, has coalesced around a plan of 50 basis points per meeting. So I think we can proceed on that. This report was hot in terms of inflation, but not that different from what was expected coming into this report. So it's not like we got a tremendous amount of information here, although I would interpret it as indicating that inflation is broader and more persistent than many have thought.
So if you do want to get to 3.5% by the end of this year, that might be a bit of a faster pace than your colleagues. So would that imply 50 basis points for every meeting throughout the end of this year? How would you like to get there?
Yeah, I think it's more state contingent than this. So we want to take it one meeting at a time. Let's see how the data comes in. It's possible inflation could moderate a lot. It's possible the real economy could take twists and turns. And so I don't think we want to be promising today what we're going to do in December. But I think right now, we're on a good path near term, and then we can adjust as we go along.
So you made a speech recently where you noted that the Fed has a little bit more room on tightening if it has credible forward guidance, which implies that markets would have to read, understand exactly what it is the Fed's doing. We see the volatility happening right now, and there's also the bigger picture about whether or not the Fed is already a bit too late to inflation here. What do you see as the, audit right now of Fed credibility?
Yeah, I gave the talk at Stanford on last Friday, and I do want to press on this point that it looks like we've only moved the policy rate a little bit because we just made the one move in March and then 50 basis points last week. But actually, we've done far more than that, as you know, from tracking the markets. The 2-year Treasury has moved up substantially from where it was 6 to 9 months ago. And it's really the 2-year Treasury that's indicative of where the market thinks policy is going to go. So by taking a hawkish turn last year, we've already put some of the policy restraint in place, even as I speak here. And so that's going to help us a lot to keep inflation under control. I don't think we're all the way there, but we made a good start, and we're going to get the policy rate up to a higher level expeditiously as we go forward here. We are, I am sensitive to being disruptive in financial markets, but here I think we've been very transparent about our policy. We've tried to communicate ahead of time what we're planning to do as best we can, given the information that comes in about the economy. And it is a fast-moving situation, but we're trying to be as transparent as we can. You're right. It's causing volatility right now. People are not waiting for the policy rate to get up in the 2.5% range, that all the effects are occurring right now. So that's the effect of forward guidance.
We're seeing markets right now, very volatile. It's been a very rough trading session in the past few days for investors. Do you see recession risks flashing in the financial markets? And is that going to be perhaps a Fed-induced recession as you tighten?
Yeah, I don't think recession risk is that high right now for the U.S. economy. Of course, you always face the possibility that a big shock will hit. And that has happened. And, obviously the pandemic was like that, even the global financial crisis. So you do have these kinds of possibilities. But I would say that our probability of recession is not particularly elevated at this time. And if you look at models that try to predict, recession or give you recession probabilities, they're still pretty low. There are a wide variety of models, so you could probably find one that'll tell you that the recession probability is elevated, but I don't think so right now. You've got this very strong jobs market, for instance, which doesn't at all look like the kind of thing that you'd see if you're sliding into recession.
Yeah, unemployment rate at 3.6%, still very low. Wanted to ask kind of lastly here about financial stability. The Fed had that financial stability report this week detailing the risks of stablecoins. And I bring this up because the volatility that we've seen in markets has led to a lot of craziness in one specific stablecoin, Luna and Terra, which was supposed to be maintaining a dollar peg. We see it has not held that level. I don't know if you've been reading up on the headlines on that front, but do you have any thoughts on the stablecoin space and whether or not that could pose perhaps a financial stability risk to the economy at this time?
I'm observing this from a distance, but I know people have been commenting on this financial stability risks associated with stablecoins. To me, they look like fixed exchange rate systems, and fixed exchange rate systems historically have not worked all that well. And so they're susceptible to attack or to loss of confidence. And apparently that's what's happening here in this particular market, but I'm a little distant from it, I admit.
Okay, but you don't think it's systemic what's happening with Terra and Luna?
It doesn't look systemic to me at this time. However, I would say that this is the kind of thing that is validating to those who have said that stable coins maybe do present some financial stability risk.
All right, well, a wide-ranging conversation right there. St. Louis Fed President James Bullard joining us here on Yahoo Finance. Thanks again for taking the time. Have a great Wednesday.
Great. Thank you.
Welcome back. Rocket Company shares are under pressure this morning after the mortgage lender reported a 41% drop in sales as the rise in interest rates put off refinances and new home buying. Let's check in with Rocket Company's CEO, Jay Farner. Jay, always nice to see you. A lot of interesting commentary from Fed members this week on their views on raising rates. I think the consensus is they have to raise rates faster. What would a faster pace of rate hikes mean to your business?
Yeah, I think we've seen some of the impact that this raise increases have already had on the market. I always try to remind people to keep things in perspective. 5.5 on a 30-year fixed rate mortgage is still an incredibly good interest rate when you think of it historically. But I think more importantly, this is just part of the cycle. And I heard your previous guest talking about inflation. And as you probably know, we acquired Truebill late last year, which gives us great insight into consumer behavior, one of the key components of building out our fintech platform, so we could watch and see what was taking place with consumers, how we help them save money, how they're adjusting to these price increases. And so although we're seeing inflation today, we also know that things are accelerating rapidly. And as people take on higher mortgage interest rates, that means that in the future, we'll be refinancing our clients, the millions and millions that we're putting on our platform, to lower interest rates, because we feel strongly that there'll be a recession coming here in the coming quarters.
And so if a recession does indeed come in the coming quarters from your expectations, how much of that would be derivative from what you're seeing currently in the housing market?
Yeah, so we're seeing people buy homes. Prices will probably slow a little bit because of the rising increase and also the lack of inventory. But, at 5.5%, people can still afford homes. But what we're doing right now is we're going to see a market, let's say $2.5 trillion of folks getting mortgages at higher interest rates. We've also got $26 trillion of equity that's out there available. And so not only are people taking cash out today, but as you move forward quarter after quarter, we see a dip in interest rates, 0.25%, and a lot of those folks will come off the fence. And so here's the key for us. We keep operating a profitable business. We keep taking care of our clients. We watch capacity come out of the mortgage industry. And then as those rates tick, we will grow, we will gain market share and take care of those clients. So this is part of the cycle. We've been through it quite a few times in the past, and we got to keep growing our marketing base, keep engaging with clients, keep seeing things like our solar, our auto, our homes businesses grow. All clients we're adding that later we can take care of as rates tick down, which they will.
Jay, you've seen several cycles, to say the very least. Now, do you think the Fed, because they kept rates for so long, we're looking at another situation like 2007 to 2009?
Well, I think it's different than 2007, 2009 in the sense that there's plenty of liquidity in the mortgage market. So that's not a concern. And the product quality is incredibly high. What we're experiencing right now is lack of demand in certain aspects of the market. And that's why we're going to go to more like a $2 trillion market this year. So it creates opportunity because what we're seeing is capacity come out significantly. You're watching lenders, cut everywhere. If you hear what we're doing, we're keeping our marketing strong. We're keeping our bankers strong, and we're diversifying. So it gives us a chance to engage with clients and grow that base, as I talked about before. And then probably we get into 23, 24, opportunities to save people money, and we leapfrog forward again. You've watched us time and time again grow market share when these cycles change. And so really now it's about making sure this platform is even stronger. So when we get that next cycle change, we can leapfrog even farther ahead and grow even more market share.
Considering the year-over-year declines that we've already seen in this most recent quarter in total net revenue, also on the adjusted EBITDA scale, is there a point where, because you mentioned maintaining profitability as a company, is there a point where you are forecasting that you would be swinging to a loss?
No, as we think about adjusted EBITDA, you'll see a lot of people talk about their overall EBITDA, and then we've got the gain in the mortgage servicing rights that we hold. So that's nice. And of course, it was, I think, $750 million increase in Q1 in the mortgage servicing right value. We hold those servicing rights. We don't sell them because we like the cash flow coming in between the servicing rights and our Truebill business. I think we've got nearly $1.4 billion of cash coming in. So it helps strengthen our company combined with the billions of dollars of cash that we've got on the balance sheet. But when we think about operating our business, we think about being profitable, not including the value of the increase in those servicing rights, each and every year. And we've demonstrated that now for 36 plus years. So we're making all the right adjustments to our business to ensure that we can maintain that profitability, so we can lean into marketing, so we can support all of those growth initiatives I've talked about. We're seeing that happen in Canada with our tech businesses. So we're getting growth everywhere. And right now in this cycle, you don't want to pull back on that. You want to keep investing, keep growing. And I talked about it before. Why? So when we get an interest rate decrease, probably as this recession occurs, that we will be there to help clients when other people have taken out the capacity to be able to do so. And again, I'm going to mention this before, we're watching clients cancel subscriptions. We're watching people already decrease their spending on food, on groceries, on gas. So we're seeing the American public make adjustments already based on the price increases they're experiencing. And so that tells us that the rise in interest rates is actually having an impact already.
All right, let's leave it there for now. Jay Farner, Rocket Companies CEO, always great to get some time with you. We'll talk to you soon.
You bet. Thanks.
What is ahead from the Fed? 2 or even 3 50-point hikes looks likely, but it's 75 on the table. Brian Chung covers the Fed for us and sat down with Atlanta Fed President Raphael Bostic. Good to see you, Brian. What did he tell you?
Hey, Dave, we're here live in Amelia Island, Florida, where earlier this afternoon I had a conversation with Atlanta Fed President Raphael Bostic. We had a wide-ranging discussion on a number of issues, but of course, the topic du jour is the 50 basis point interest rate increase that we got last week. The first natural question, well, what's next from the Fed? Take a listen to our conversation from earlier this afternoon.
Well, for me, I think the overarching perspective is that inflation is high and it's too high, and we have to do something to work against it. So we've taken good first steps. I think the 25 basis point ratcheting up to 50 because of where we've gone. And I think that's the pace we need to stay at, getting 50 basis point increases, maybe 2 for the next 2 or perhaps 3 meetings. And let's just keep this moving to make sure that we're doing all we can to get inflation under control.
So for a lot of Fed officials, it seems like the goal is to get to neutral, at least for right now, which is the short-term interest rate that's neither stimulative nor restrictive to the economy. What's your estimate of neutral, and how fast does the Fed need to get there?
So, neutral is it's a concept, and so it's not as if there's an equation, exactly where it is. For me, it's somewhere between 2 and 2.5%. And then in terms of getting there, I think we just need to get there in a sort of methodical way, so that we are really signaling the pace at what we're going. And then, of course, we have to wait and see what happens. So as we are moving, we haven't really moved at a 50 basis point increment for many, many years. So there is still some uncertainty as to how the economy will respond. And so we'll be watching as we go along. But my view is like strong and steady, and let's get there, be very intentional about and purposeful about getting to that level.
So a lot of chatter, speculation about whether or not moving the Overton window from 25 basis points of moves to 50 basis points moves would spur eventually a 75 basis point move. What's your assessment of whether or not that's something that could be on the table?
Well, I think it's definitely on the table. For me, everything is on the table. So I really don't prejudge or predetermine in my mind things that I absolutely won't do. But the world would have to change pretty significantly. We would need to see some real negative shock on the real side of the economy for me to really bring that into a higher probability type of a possibility. It's not my baseline right now, but I'm going to be open to everything, because we need to do all we can or whatever is necessary to get inflation under control.
And it's clear that the big bright line test for that is going to be inflation. We're going to get another read on inflation in the form of the consumer price index tomorrow morning. Not going to ask you what your expectation is for that, but when would you expect broadly the bite of the 75 basis points in total hikes we've had between March and May to be seen in the inflation data?
Well, that's a good question. So, to me, it's heartening for me that we've already seen it take some bite into financial markets. If you look at the 30-year fixed rate, 30-year mortgage rates, they have moved far more than we have, which suggests that markets are taking these things on board. And I expect that we'll start to see that start to ripple through into the economy more broadly. I'm hopeful that over the next several months, we will start to see that inflation level start to come down in a pretty steady level. It's already gotten to a place where month to month, we're not seeing the continued acceleration in inflation, which I think is a very positive sign. And now I'm just hopeful that will continue as we move forward.
Anecdotally, when you have conversations with specifically households in your district, what are you hearing from them? I mean, President Biden was speaking, earlier in the afternoon, just kind of about how big of an issue inflation is, some fiscal policies on the table, perhaps, eliminating the Trump tariffs. Are these types of things that you're hearing from households in terms of what the Fed can do specifically to make sure prices can go down?
Every day.
The speed, rather.
Yeah, I hear about this every day. And everywhere I go, people are very much noticing that inflation is happening. I think they're open to understanding that a lot of this is driven by the COVID dynamic, where we have supply shocks that are preventing the economy from producing goods to match that elevated demand. But everyone's feeling the inflation. People tell me what their price of gas they paid this week was relative to 3 months ago. It's something that we definitely, and I have taken on board, that it is hurting people, it is creating stress for them and uncertainty. And that really goes back to where I really started, which is we really need to get this under control as fast as possible, and that's exactly what we're going to do.
One talking point that we're hearing a lot is whether or not the Fed overdid it, and that's the reason why we're in the situation that we're in right now. Is that something you also hear from households in the district? So
I'm not hearing very, very many among regular people theories about why we are or how we got to where we are. I hear much more that I know where we are, and I'm very sensitive to this, and it's something that I'd like to see change if possible. I actually don't think the Fed overdid it. I think that we had a great uncertainty in the economy as we were going through the pandemic experience. And for me, I think if I was going to want to do too much or too little, I'd rather deal with an economy that had strong fundamentals and foundation. We're still creating lots of jobs. We are seeing the demand that is sustained. The other alternative is losing a ton of small businesses, having families that are in much more precarious positions, and that is actually a much more painful environment to be in.
And on the labor market, the jobs data that we saw last week showing massive job gains still in the last month. We also got an unemployment rate that's still at 3.6%, close to the pre-pandemic levels that we had seen. Is there a risk that as the Fed tightens, that the unemployment rate is going to go up, that people will be maybe put out of jobs as a result of the tightening?
Well, I think there is that risk, but I would also just start where you started, which is if you're averaging, before last month, we were averaging about 600,000 new jobs a month for the last 8 or 9 months. We know that the job vacancies far exceeded the number of the people that were filling those jobs. So the first thing that I'm expecting will happen as we start to slow down and retard demand is that vacancy to filling gap will narrow. So I think if we're going to see unemployment go up, that's likely to be down the road a ways, and then we'll sort of deal with it then. So, but it is a risk. It's just not one that I think we're going to have to really face in the near term.
And how do you think about that within the context of the overall concern about the Fed tightening into a recession? Because the whole idea is to tampen down demand. So that might necessarily involve 2 quarters of negative GDP. And I was talking about this with your colleague in Cleveland earlier. Not necessarily always the definition of a recession, just that metric. But by and large, there is a concern that the labor market might show signs of a recession as this process is underdone.
Well, I often say I get paid to worry. So I am very aware that these are concerns. And this is why coming through most of this year, I've used 2 words to describe my approach to policy: observe and adapt. Things are going to happen as we make our policies and we move things along. And my job is to pay attention to that and try to notice when there are turns such that if we move in certain ways, that could contribute to more pain. And so then I want to adapt my strategy moving forward. And, there's a lot in this economy that is complex. All the supply side issues, the war in Ukraine, those are things that are not our policies, but they will affect what our policy will need to do. And so we just really need to pay attention to that as we move forward. And my goal, and there's another thing I always say, is my goal is for us to not have a recession while I'm sitting in this chair moving forward. So I'm going to do all I can to try to get to that softer landing.
Is there a role that fiscal policy can play to help you and your colleagues on the monetary policy side out? I mean, again, talking points from the Biden administration, possibly loosening the tariffs from the last administration or doing other types of measures to try to lower prices?
Well, certainly there are a lot of factors beyond our control that are going to determine sort of the ultimate trajectory of inflation. If there's help that can come from other sources to try to either stimulate supply or reduce demand, I think the fiscal side is going to be much more on the supply issue because ultimately what we have right now is an imbalance between high levels of aggregate demand and low levels of supply. And as you know, when demand exceeds supply, that puts upward pressure on prices. So that's that gap that we've got to try to narrow.
And then I want to ask about the housing market. Something that's very interesting is the kind of idea that the higher costs of housing that have gone up dramatically during the pandemic are going to be longer term impacts and crowd out possible spending in the future. I mean, is there any sort of longer to medium term impact that you're seeing from the rocket up in American housing prices over the last 2 years?
So we have not seen that so much, but it is a concern. And I know a number of families that I talk to are expressing concerns about, where are my options and how much of my income is being eaten up by my housing costs. And it's just something we're very much going to have to watch. One of the things I really appreciate in the network of the Federal Reserve is we do lots of surveys to try to understand and identify whether there are those shifts. How we deal with, how households deal with the current environment and housing is going to be an important component of that. And it's something we're going to have to monitor very closely.
And then one more question before I let you get back to the beautiful sunny skies here in Amelia Island, Florida. But quantitative tightening, the process is going to begin June 1 for the Fed to shrink its nearly $9 trillion balance sheet. The plan is to get it up to a $95 billion a month pace by the fall of this year. Could you see a scenario where the Fed might want to perhaps accelerate that process if it is indeed the case that maybe a stronger drawback is needed?
Well, first, I want to say I'm very excited and pleased that we're doing this. This is something that I've been saying for a long time we needed to take care of, and it's good to get that in motion. Ultimately, I think we are going to have sales. One of our principles is that most of our balance sheet holdings in this space need to be in treasuries and not in mortgage-backed securities. And so if we're going to get to that, sales will have to be part of the equation. We're just going to have to really monitor in real time to figure out when an optimal time for starting that will be. It won't be at the beginning. I think what we want to do is really see how the markets respond to our pulling out some liquidity from these spaces, and then we'll sort of have to make a decision at that point.
So the big takeaway, again, from the Atlanta Fed president, that it's really 50 basis points that is his base case scenario, at least for the next few meetings, although 75 and anything else is really still on the table, echoing what we heard from the Cleveland Fed president, Loretta Mester, who spoke with Yahoo Finance earlier this morning. You can find that conversation as well as a replay of the conversation you just heard on our site, yahoofinance.com. Guys.
You covered a lot of interesting ground there. We do appreciate it. Yahoo Finance's Brian Chung there.
A perspective as the markets get whipsawed on recession worries and probably rising gas prices. Standard recessions have caused an average 26% decline from peak to trough earnings for S&P 500 companies dating back to 1990. Notes data track the 2007 to 2009 Great Recession saw S&P 500 earnings decline by 57% from peak to trough.
Well, everyone, the market extending its losses this morning. Currently, the Dow is sitting right now lower by about 395 points in the futures, with the broader markets also lower as well in the futures. The S&P 500 and the NASDAQ, you're taking a look at the past 5 days decline. 5 days, S&P 500 down 0.2%, NASDAQ down over that time by about 1.5% over the past 5 days. So joining us now to dive more into the markets, we've got Citi U.S. Wealth Management Head of Investments, Sean Snyder. And Sean, particularly here, you write in your note that the financial markets appear to be caught in a traditional growth scare. I mean, if there is anything that is scaring the markets right now, it's not just happening in the U.S., it's happening broadly as well. And so what would you kind of extrapolate towards the move that we're seeing this morning internationally, and what does that set up for today's trading session?
Right. Well, the roller coaster continues, right? So we're seeing yields higher and stocks lower. But why is that happening? And why that is happening is we're actually going through a period of transition where the stimulus, the sugar rush from stimulus is wearing off. So the U.S. economy is potentially slowing from a rate of growth of 5.5% in 2021 to something that's maybe closer to 2% in 2022. So stock market is adjusting to lower growth. And at the same time, you have the Federal Reserve tightening monetary policy into a downturn, and you're seeing bond yields rise. So it's making for a very difficult environment for investors right now. But the key question is whether the Fed can break this cycle of rising prices without breaking the economy. And that's something that we need clarity on, but we're probably not going to get clarity for a while. We at least need to see inflation fall or bond yields stabilize or growth stabilize as well.
Sean, none of that stuff sounds like it's going to happen in the near term, which raises this question. Do you think we're headed for a bear market?
I think there's certainly the potential for that. I mean, at the end of the day, this either ends up being a traditional growth scare, at which case I would think that equities would actually rebound sharply if we get to that point. But if we are headed towards recession, and again, I think those probabilities of around 30% are probably accurate, then I would say there's more downside. But if there's a silver lining here, there's a couple things. One, we may see a peak of inflation in March. So Wednesday, we get the April CPI print. I think it's widely expected that the inflation rate comes down a little bit, maybe from 8.5% to 8.1%. I think will be trending in the right direction. I think that's a positive, even though it's going to stay elevated. And the other silver lining here, I think that people are kind of ignoring, is that we still have time. There is time to correct this. If you look at leading economic indicators in the United States, they're still positive on a year-on-year basis, well into positive territory, about 6.4%. Traditionally, they fall below 0%. Prior to recession. So I think the odds of recession imminently are relatively low. That means there is a window, like the Fed says, where there's a plausible path that they can achieve a soft landing. And I think that is the key question. It's going to take a while to find that out, but I think we'll have more clarity in the back half of the year. And I think we could look back and just see this as a traditional growth scare.
Sean, it's Julie here. You say in your most recent note, panic is not an investment strategy. So you sound very measured and very reasoned here. But I am curious, sentiment-wise, if what we are seeing in the market right now is it a traditional growth scare? Has that tipped over into panic? And if so, does that then provide a lot of market opportunities for people who can remain unpanicked?
Well, last week was really the first time I got a sense of panic from clients and our financial advisors in some regard. But if you look back at the week, what you saw is up 900 points on the Dow one day, down 1,000 points the next day. And I think there's a really key takeaway from that. And that is that time in the market is more important than timing the market. So since 1990, simply staying invested in the S&P 500 would give you an average annual return of 10.8%. Or if you tried to time the market and you missed the 20 best days, that average annual return declines to 6.3%. And I would also point out during that same time frame, 8 of the 10 best days occurred within 2 weeks of the 10 worst days. So timing the market, it sounds appealing, especially in difficult times like this, but you tend to miss those strong rebounds when we do get them, and that weakens returns over time. So panic is not a strategy. So what I would recommend doing, or we're recommending to our clients to do, is have a more defensive tilt. So what you do is you move into things like companies with strong earnings growth, good track record of dividends. You could look at the S&P 500 Dividend Aristocrats Index, which represents those companies, a lot of consumer staples in there, and they're down about half as much as the regular S&P 500. So it's down 7% instead of 14%. So I think there are some areas of the market that you can look to for a little bit of safety. The other hedge I would recommend is natural resource stocks, agriculture, oil field services. Those types of stocks give you some sort of insurance should we see inflation not start to come down. And then the other things, I do think bonds are back in some way. I know we're still seeing yields rise, but I do think that if you saw more material leg down, say you did enter recession, holding something like a 30-year treasury bond at these yields should provide you some sort of volatility buffer in a market that goes down further.
How much about timing the market right now is about timing the Fed as well? I mean, you say don't fight the Fed, and that continuing to be an apt description once again. But for the Fed that's going to be looking across the strength of the economy, how much of this just comes down to timing the Fed as best as possible?
Well, I think that's right. I think there's definitely one person that can kind of change this position, and that's probably Chairman Powell. But they are trying to tighten financial conditions, and that unfortunately means higher bond yields and lower equity markets. And that's one way you get to lower inflation. So at what point do they decide enough is enough? That's difficult to say. But I do think there is a very plausible chance that we could start to see inflation decline in the back half of the year. That will allow the Fed to have more nimble policy and to maybe be more patient. I think what we really need to see is that they're not maintaining the same path well into 2023. If they somehow eventually, pause or kind of reassess later in the year, then I think that may help us get to the soft landing that we're all hoping for.
Sean Snyder, Head of Investment Strategy over at Citi U.S. Wealth Management. Thanks so much for joining us this morning ahead of the market open.
Well, let's stay on the bad news. Goldman Sachs is reiterating its 35% probability for a recession within the next 2 years. A new note from strategist David Kostin also said macro factors are outweighing a strong earnings season and estimate boost. He goes on to write this: the boost to analyst estimates has not been enough to offset portfolio manager fears about the downside risk to EPS if the economy falls into recession and the downside risk to valuations as the Fed tightens policy. Now, guys, I don't want to blame Kostin for this pre-market sell-off. Last week's market action was just not good at all. But still, this is probably one of the more upbeat strategists on Wall Street saying, hey, guys, listen, earnings season has come out pretty well, but we're now starting to see estimates come down, and you're seeing the market act accordingly, and that's a big red flag.
Well, one of the other things he mentions is that even if we don't get a recession, that doesn't mean blue skies for stocks. And I think that's also what spooks people in this market as well, is that there's all this recession talk, and he's saying, well, recession isn't the only problem that we have here.
Yeah, and just briefly here as well, swings will remain large until the path of inflation is clear. With that comment, I mean, we've already seen the impact that these price swings and the volatility have also had among some of the retail investors out there. And if you see a broad move from some of those retail investors stoked by fear out of the markets, what in terms of the momentum trade does that also set up in the near future, too?
Just one more call I wanted to mention this morning. You can't just lay it all at Costin's feet. Michael Hartnett over at Bank of America, maybe he can take a little bit of the blame for the negative sentiment, or at least is another reflection of the negative sentiment. He says the S&P 500 is moving closer to a bear market plunge, which of course would be positive. At least 20%. He says the 19 bear market plunges that occurred over the past 140 years last on average 289 days. That means we've got until October 19th, if indeed we are going to enter a bear market.
We have RJ Gallo, a Federated Hermes senior portfolio manager, and Sarah House, Wells Fargo senior economist, as we wait for Fed Chair Jay Powell to begin his remarks. Sarah, first to you, what questions would you have for Powell this afternoon?
So I want to know more about their tolerance for growth slowdown or potential recession and inflation. So do they need to get back to 2%, no matter whatever it takes? Or if we see the economy slipping into recession, at that point, are they maybe willing to ease up on the pace of tightening and perhaps let inflation run somewhat over 2%? And if so, roughly what rate, if that means mitigating the outright contraction in the economy. So just trying to get a better sense of that trade-off between inflation and growth, given just how tricky of a situation the Fed finds itself in.
Just in case our Brian Chung is taking notes, RJ, what would you like to ask the Fed chair?
I'd be focused on the balance sheet plan myself. In particular, a number of years ago, I worked at the Federal Reserve Bank of New York. The system open market account was less than $1 trillion, and it was basically all treasuries. The world has changed massively since then, and there has been some talk that some on the committee would like to get back to an all-treasury portfolio. I think some greater clarity on that is going to be required by the markets over time, and I would like to understand what the chair thinks about the composition of the portfolio. If they do want to go back to an all-treasury portfolio, that's a profound development for the mortgage market. They haven't unveiled that yet, and I think we need to keep putting pressure on them to offer as much insight as they can going forward on that issue.
So, Sarah, do we have an idea of where we are in terms of the economic recovery narrative based on the most recent data, as well as the moves that the Fed is making?
So, in terms of the recovery, obviously we've seen output has more than recovered. The labor market, we haven't seen jobs recover, but essentially in terms of overall tightness, we're back to where we were. So I think in many ways we've seen this recovery surprise time and time again. And I think overall we're looking at such a strong economic backdrop that's why we do have the Fed embarking on this fastest tightening cycle we've seen since the mid-1990s.
RJ, right now we do have a hawkish Fed, but there is this risk, though, that inflation could potentially be stickier than what maybe we initially are thinking it could be at this point. How are you positioned, or how should investors be positioned right now?
Well, on the fixed income side, across our actively managed portfolios, and we are an active manager, we don't run passive strategies currently at Federated Hermes. We've been materially short duration for quite some time. Go back a year, 9 months ago, transitory was a pretty hot word. It proved to be a false word. Inflation proved to not be transitory. In fact, to be quite persistent and quite a bit higher than many anticipated. We felt that the inflation problem was going to be more problematic than the market. So being short duration has worked. We think most of the pain in the terms of the rapid bond market sell-off that has characterized the last 5 months or so, most of the pain is probably behind us. At this point, the market is expecting a terminal Fed funds rate around 3.4%, give or take. We think that's a reasonable expectation. It wasn't that long ago. That number was still in the twos. So the bond market has incorporated a lot more tightening than the Fed has already done. And that's because these days the Federal Open Market Committee, it's almost sort of like the Federal Open Mouth Committee. They communicate through projections, through speeches, through very detailed minutes, what their expectations are. And the market has repriced to those expectations given the extremely high inflation. They give a lot of credibility to the idea that the Fed indeed will be hawkish. So a lot has been priced into the market to take the expected Fed funds rate well north of 3%. So I would argue going forward, bonds are still a little tough for investors, and I expect some further upward drift in yields but we're not as aggressively short as we once were. For a while, we've been favoring floating rate notes and tips. We've turned those preferences down in our portfolios, adding more fixed rate treasuries. It's probably time to get a little bit more incrementally positive on fixed income returns from here after they've gotten bludgeoned, really, to be frank, on a year-to-date basis.